You've heard it your whole life, and it's as true can get. You make your money on the buy. You're getting the advantage of this based on buying as a contrarian. We bought when nobody else would buy. You know, one of the things that sometimes we as investors forget is to take things down to this most simple core assessment. I'm talking about mineral rights, and I'm talking about mineral rights in terms of acquisition price. And I'm talking about the ebb and flow of the market and when to buy and when not to buy. Now, bear in mind, we've been heavily at this in the Anadarko Basin and the Permian and the Williston Basin now for 17 years. We accelerated our focus starting in about 2019 on being, we believe, one of the largest private owners of mineral rights in the Anadarko Basin because we had a model, we had a plan, and we built a team around that. But I'm gonna give you some examples today that I want you to keep in your mind, and I want you to think about this carefully, all right? So we've seen mineral rights go from about $6,900 an acre, and I'm gonna say, let's just hypothetically say, these are all the same. These are two-section minerals with a producing well and at least one more well that's expected to be drilled. So one more that's coming up under regulatory. I just want you to know that these are all the same. They're all tier 1. So just for my analogy, all exactly the same acres. The difference is the time and commodity prices. So timing, when we invest, commodity prices, and I'll add one more in, technology. Three items that directly affect what we paid and what it looks like. Now, let's go down and tell you what I got on the board to make it really easy for you, right? So I said, for me to make 10% return a year, math's easy. I need 690 down to 1,500 bucks a year based on my per acre price, okay? My per acre price up here is my basis. You've heard it your whole life, and it's as true can get. You make your money on the buy. Now you might ask, well, why would Eckard ever not avoid the market if it goes to $15,000 per acre? I would only buy at $6,900 because I only need $690 a year in revenue for me to get 10% return. I gotta have 2.17 times that revenue if I buy at $15,000 an acre. If I buy it at these different prices, it tells you what I gotta make to get $1,500 in value or pay $15,000 per net royalty acre. Well, again, what varies on that? It's gonna be the timing, the commodity prices, and the technology. Well, what's the timing? The timing is, at the time we might buy the $15,000 per acre, it might come with 4 ducts on the property coming online in the next 30 to 60 days, and we have the Russian war coming on, and they're paying $129 a barrel. And our financial model shows that if we have any ability to recognize this is the current commodity price, even though our model stays the same, our model stayed the same, $65, $70 oil, $325, $350 for natural gas, but we know these ducts are coming online at really high prices, which means the flush production, the highest volume output for the next 6 to 18 months coming out of that well is going to happen when we see $129 oil. Everybody thought the Russian war would be over in 6 months. We're now in the 4th year going to the 5th year. As a result, we paid $15,000 an acre because we could capture 4 brand new horizontal wells coming out at 800 to 1,000 barrels a day that were going to sell 80 to 120,000 barrels of oil in the first 12 months at $129 a barrel. It made all the sense in the world to buy these minerals at that price. So that's the timing, and that's commodity prices. Now today we're dealing with a multitude of things. We're dealing with high oil prices today because of the new war in Iran. Still have the war going on in Russia. But we got better technology, okay? We have better timing in that there's fewer wells being brought online, which means our production curve, production output is leveled off in the US. Decline curves are still in place. We've used up all of our strategic petroleum reserves. We're about to release another 170 million barrels. What it really means is, where do we want to be in the buying market? We've been buying right here for the last 12 months, and most of you have had no clue the value that we've been giving you. Why was the value there? Commodity prices were flat and going down and projected to go even lower. So the sellers were selling into a buyer's market, very few buyers. They were selling into a decreasing commodity price, They weren't seeing the level of activation. So from a buyer's perspective, we were in the driver's seat. We said, we have money to spend. We're paying these prices. We're not paying these prices. From a technology perspective, we knew we were getting 1, 2, 3 mile laterals, better fracking, better technology, better wells, better well results. The production just keeps going up. So we knew we had a double-edged sword. We're buying really low cost per acre. We've already factored in the lower commodity prices. We're looking at the timing of that because we're only following the filings of regulatory activity. So we're going off of what's empirical data, permits, applications, DUCs. But now we have technology on our side because the oil companies had to get better. In the last 2 to 3 years, they've had to get better every way in terms of drilling, cost savings, efficiency, fracking, vendors, everything. So we're seeing wells drilled on our minerals at 20 to 40% below market value, which means what? The oil companies are actually making as much money today per well, per dollar spent, as they did when the Russian war was going on. If I can take a well during the height of the Russian war, wells were costing $12 to $13 million per well. We're getting wells down for $6.5 million, almost half price. That means I can take half the commodity price, I can take half the production and do economically just as well. What's the point of this little presentation? When I think about how to invest in any market, it's not about timing the market, it's about timing the value of the asset, the entitlement, the underlying value of the asset itself. In my view, each one of these acres at each price has the same reserves in place. The reserves haven't changed. The economically recoverable reserves, the quantity you can get out today based on drilling cost and technology, is the same. So if every single acre at different price has the same reserves in place, the same percentage of recovery reserves in place, really it's the bottom line of economics. So if I bought acreage here, I bought it because I had a bunch of wells coming online. I was capturing a unique event that allowed me to get upfront cash flow that paid me back quicker, and the front-end cash flow reduced my basis by an accelerated return of investment, or accelerated return of a return on my investment and of my investment, right? Somewhere in between is a variation of that. You're getting the advantage of this based on buying as a contrarian. We bought when nobody else would buy. You're now becoming our partner and owner by doing that, buying these assets today. Your basis is so low, all I need is $690 to pay a $6,900 acre to get 10%. But if I take that right there and I multiply that times a 40 to 60% increase in commodities, now I'm making $1,200 to $1,400 per acre, now I'm making 18 to 25%. Guess what? I'm getting the value of this with an investment basis of this. See, I don't try to time the market. I try to time buying the asset at the right time at the right price. I'm looking at the fundamentals the same. The reserves are the same, the recovery's the same, the output's going up. What's changed is better technology, more favorable commodity prices, and the timing is what? We're not going to buy more acreage at $6,900 an acre. I can guarantee you that. This is as low as prices we paid since 2019. We're probably headed to this direction because if oil prices stay high and the Iranian war stays longer, sellers are not going to sell because the cash flow model doesn't show going to 40, it shows it going to 100 to 150. Even if it goes back to what I call a normalized market at, let's say, 75 to 80, that's still a 20, 30% increase from when we bought these minerals. If I'm a mineral investor and I like fundamental value and I understand the economics of return on investment, I'm buying as much as I can buy today because that going out of business sale, that 50% off sale you have on New Year's Day when you go shopping in Dillard's like I do because I love value, I'm never going to see acres this cheap again for probably 5 to 10 years if I see it again. I want you to know this model is not something that's just fictionary. This is reality in terms of cost, investment opportunity, and return. Buy as much as you can here. You buy here because of the special economics, but you'll load up like you've never loaded up tomorrow here because I can buy almost 2.17 acres for the same price as this. Thanks for listening.